Gold hits a 5-week low this Wednesday as we await the FOMC. Peter Hug joins me next. And sporting a new look today, Peter Hug joins me. Peter, thanks so much for being with us.
My pleasure, Daniela.
So I know you're excited. You can't wait for those minutes to come out today, right?
Yeah, I'm sitting on pins and needles.
All right, so Peter, let's start off and look at Bernanke's words and statement yesterday. He basically reaffirmed that the Fed would keep interest rates near zero for a long time, even after QE. What would that mean for the economy, Peter, if the Fed begins to taper but interest rates remain low?
Well, I think it's I think the Fed wants to taper. I believe it's going to happen in 2014. I think it'll be a very slow process. I'm still in the camp that believes tapering won't even begin to be on the agenda until spring of next year. And it won't be an 85 billion bond pullback immediately. They'll probably go in tranches of either 10 or 20 billion a month or a quarter. And this could take, another year before the 85 billion in bond purchases are completely off the table. And then Bernanke has basically confirmed, even after that, that Fed rates closer to zero are more likely to be in our future than interest rates creeping higher.
So what would that translate to for gold, Peter?
Again, on the metals markets, the catalyst for gold, the next major leg, the final leg of the market should be an inflationary leg. I'm still concerned that the central banks, both in the U.S., Europe, and Japan, are fighting a deflationary war. They're worried about the economic growth gaining traction. And, that's why they're in the camp of keeping their monetary policy easing. And I'm not sure that's beneficial for gold in the short to intermediate term. Until we get an inflationary scenario, assuming no accidents and, there's no major geopolitical risks and there's no major financial risks in the immediate horizon, I think it might actually be negative for the metals. We're, I think, in a deflationary environment.
Peter, we also saw retail sales come out higher than expected. Do you trust these numbers given the recent revisions we've seen with job figures?
I don't really trust a lot of the numbers that come out of the government. I think the key will be Christmas sales. Again, I'm a little cautious with the fact that some of the significant chain stores are opening up on Thanksgiving Day. Indicates to me that they're trying to get that consumer to spend as early as possible. They're not looking for a very robust Christmas season. I think the unemployment numbers are not accurate. I don't think we're at 7.4% unemployment. I think the actual rate is probably closer to 12%. I'm just not seeing the legs in this economy that would indicate to me that we're on a path of robust growth. I mean, it's going to be a grinding path probably over the next year or two as the economy just sort of staggers on.
So let me ask you now, and I'm pretty sure I already know the answer to this since I ask you every time, Peter. Could we see any surprises emerge from the FOMC today?
I'd be amazed. After Bernanke's speech last night, I can't imagine he'd be saying something different than what the minutes are going to reflect this morning. And I think they're going to hold status quo. The economy is starting to heal. It's nowhere near strong enough to consider tapering, and the Fed will be accommodative as long as necessary. I think that will be the message that we'll read in the minutes.
So, Peter, let's look at gold and silver closer now. What key levels are you looking at for the metals?
Well, this morning was the buy at 12.56. If you're a trader, that was significant support. It bounced off it. It has to hold that level. If we don't hold 12.55, I think 12.27, 12.32 is the next target. It's likely not to break through that support level today with the Fed minutes coming out. I think people will just wait and see. But the fact that they tested it bounced, gives some hope for a short-term correction on the upside in metals. but the overall feel of this market remains heavy and the technicals look terrible.
And how about for silver, Peter?
If, as I said last week when we were doing this show, if we lose gold at 12.55, I see silver in the teens. Initially 1940. If we lose 20, but it's conceivable that if gold breaks 12.55, it's conceivable we could see silver between 1870 and 1920 sometime next week.
All right, last question before I let you go, Peter. In your morning commentary today, you write that cash is king. Where would you put your money now, Peter? Well,
I think you have a relatively good paradigm. I know the markets are at the high, but still a very good paradigm to be in the equity markets. Earnings are at about 15 times book, which is a reasonable valuation. The Fed is going to continue at zero. I think there are pockets of real estate that I would be looking at, interest rates being where they are. And the equity markets, more on the blue chip side here, would be a place I would park some money. And I would have it in short-term bonds, no further extension than maybe 2 years out, because I do think the interest rate environment will continue to be soft.
Good. Peter, and you'll also be saving for my Christmas gift.
That's right. I've got it all put aside for you, Danielle.
Excellent. On that note, Peter, thanks so much.
You're welcome.
And thanks for watching this edition of For Pete's Sake. We will catch up live with Peter next week in San Francisco at the Metals and Minerals Conference. So we look forward to seeing you there, Peter. In the meantime, you can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.